Welcome to our Moss Adams Reserve webcast, The Art of Balance Sheet Management. I'm Kelly Walsh and I'm the moderator for today's call. The presentation you're about to see is not legal or accounting advice. We encourage you to seek the services of a professional service provider to apply this content to your specific circumstances. Today's presenter is Kenny Martin. Kenny provides accounting, auditing, planning, and risk assessment services to a variety of wineries and vineyards throughout the West Coast. And with that, I'll hand the presentation over to Kenny.
Thank you, Kelly. During the program, examples will be used. The examples are meant to illuminate a point and or make generalizations. Please note that conditions in your winery may be different, and that's okay. Today's topic actually came by request from a previous program. It refers to a document representing a snapshot in time. I would like to expand this view and look at it from a number of angles. After today's program, my hope is that you'll have at least one new takeaway for balance sheet management. Should you already be performing most of these tasks, your takeaway might be affirmation that your current process is functioning. So what's the goal? The goal of balance sheet management is timely, logical, and comprehensive decision-making, resulting in efficient operating profitability. In short, this means targeted action, taking all the moving parts of a business that affect the balance sheet, pulling them all together into a formative and useful tool. When we look at the balance sheet from a past, present, and future perspective, some strategies emerge. You can mine the past, specifically financial and non-financial data. By financial data, I'm referring to historical accounting data. The benefit of financial data is it's readily available, inexpensive as the cost of it has already been incurred, and thus creates value. If you're not using historical accounting data, you're likely missing out on an opportunity. The past can help provide perspective when answering the following question. Where am I at today? I'm a firm believer that developing a plan of action starts with a true self-assessment of where you're at today. Without it, conceptualizing how to get where you want to go is difficult. Crunching numbers on the following can assist in understanding where you're at today. Although there are numerous key metrics for the balance sheet, understanding working capital and debt management may be the most important. Market-based forecasting. Notice I didn't say historical forecasting. Although the past can suggest ranges of outcomes that may occur in the future, forecasting based on expected market conditions is preferred. Once a market-based forecast is developed, ratios and relationships can be compared with historical records, thus ensuring expectations are within acceptable ranges. The tools needed to implement balance sheet management strategies are simple. First, financial and non-financial data. It's important to note that consistency between data sets, likely in years, is a must. Without that consistency, it can really kind of blur your data points. Financial data can represent an account balance, average cost, or other accounting activity. Examples of non-financial data include harvested tons, number of producing acres, or production volume. Second, you need a modeling forecast. An Excel-based template is adequate for this purpose, but must be tailored to meet your specific needs. Lastly, elbow grease. Effort will be required to create, implement, review, and update the financial and non-financial data within the forecasting model. Reporting efforts will need to be done on a periodic basis to accumulate the relevant information, and once reporting is complete, someone of an appropriate level, likely a decision maker, should be monitoring actual results with predetermined expectations. I like to refer to this as KISS monitoring. KISS stands for Keep It Simple. If your balance sheet management system is too complex, it's more likely to accumulate dust than provide benefit. Looking back on prior results can be as simple as looking at prior balance sheets. However, using ratios and relationships can provide comparability between the years. This slide contains possible ratios and relationships that could be tracked and compared. Many of the examples are focused primarily on economic engine of a winery, inventory and wine production. Examples include cost per gallon, maybe cost per case. Each of those components could be broken down further into grape cost per gallon or overhead per gallon, overhead per case, bottling cost per case. Other types of ratios provide data points as well and suggest different aspects or categories of a company, including liquidity, solvency, and other operating metrics. With so many to choose from, I recommend picking those that provide the most insight into your balance sheet. Scaling these down to a smaller number of let's say, key economic indicators will yield an analysis that's a little bit more easily digestible. When accumulating these historical records, a couple things to keep in mind. Multiple years is helpful, provides perspective, and again, comparability of the underlying data is a must. So what do we do with these? Here's an example of how historical ratios and relationships could be presented. The schedule includes 3 periods and 3 categories. For liquidity, the current ratio, quick ratio, and working capital amounts are common data points. Working capital is a measure of the company's efficiency and its short-term health. Negative working capital means the company is currently unable to meet its short-term liabilities with its current assets. In our example, we see improvement in the current ratio from the 3rd prior period to the 2nd prior period, then kind of levels off for the 1st prior period. Although inventory, specifically wine inventory, is always classified as a current asset, many wines are aged for longer than 1-year period. This is why I've included the quick ratio, which is similar to the current ratio, however, excludes the effects of inventory. The quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. The higher the ratio, the better position of the company. Solvency is the ability of a company to meet its long-term fixed expenses to accomplish its long-term expansion and growth. The examples here may not be used to make your own internal operational decisions. However, I've included them here because they're relationships that are likely considered by your banker. For operating, I've chosen to highlight a number of ratios measured in days, as they provide data points on how long cash is tied up. As you're all aware, producing and selling wine is a capital-intensive business, placing a premium on cash. Changes in inventory, accounts receivable, and accounts payable balances result in both inflows and outflows of cash. What may be less apparent is how many days cash is tied up in these accounts. Even less apparent is how many days it takes for cash to be consumed by payables, absorbed into inventory, and ultimately converted back into cash through accounts receivable collections. Individually, these are identified as average days in accounts receivable, average days in inventory, and average days in accounts payable. For average days in accounts receivable, we can see the days range from 13 to 18 days. By broader industry comparison, this is actually quite short, however not unusual for the wine industry. Average days in inventory is quite a bit longer. Notice the range is from 292 days to 397 days. Ideally, average days in inventory is less than 1 year, meaning inventory turns at least 1 time per year. Special consideration should be given when this exceeds 1 year. That's not to say that it's necessarily a deal breaker if it exceeds 1 year, but again, some special consideration needs to be looked at. For average days in accounts payable, we can see that payment is made to vendors within 52 to 69 days. This is an example of maximizing vendor timelines and pushing out and capitalizing on cash utilization. Now I'd like to switch gears a little and move into balance sheet line item reviews. These reviews should be performed on a periodic basis and act kind of like a check-in for each line item on your balance sheet. The length of time needed for a review should be linear with its importance. So for example, more time should be spent on cash and inventory than prepaids and accruals. Let's start with cash and reflect on the competing demands such as funding operations, growth of new varietals, possibly new brands or entry into new markets, servicing capital requirements such as debt, and funding contingencies. Each of these elements needs to be accounted for. With numerous items to consider and a long lockup period as demonstrated by the cash conversion cycle, a systematic approach to managing cash can help. Think about your own personal finances. If you had some extra cash with which you could purchase a CD, would the amount you'd be willing to commit to a 30-day CD be different than a 1-year CD? My guess is more thought is likely to be needed prior to locking up your cash for 1 year, given the unknowns over a longer period of time. Things you might consider: am I expecting any major expenses? Or do I have enough should something unexpected happen? This is similar to the wine business, as the cash conversion cycle can and often does approach 1 year. On the next couple of slides, I want to walk you through an approach to managing cash on a periodic basis. In this example, we have 4 periods. The frequency of each period may vary, but monthly would be my suggestion. For those entities struggling to maintain available cash flows, increasing the frequency to a weekly basis may actually work better. How many future periods to include is a matter of judgment. I've heard some going out as far as 5 years. However, I do think this involves a significant amount of estimates, but at a minimum, a rolling 12-month approach should be considered. For those of you not performing this type of analysis, the first run-through can be very illuminating. So let's look at step 1. Determine cash flow from operations. In its simplest form, this is cash receipts versus cash outflows. For this example, cash receipts includes cash sales and collections on accounts receivable. For cash outflows, we'll use purchases, accounts payable disbursements, asset purchases, payroll, and debt payments. At the bottom, for each period, calculate net cash flows. So in our example here, for period 1, we have total receipts, $260,000, total outflows, $270,000, so we have a net cash deficiency of $10,000. Again, for period 2, period 3 is a little bit unique in that we have a decrease in expected receipts of $210,000, but we introduce an asset purchase and a required debt payment, thus increasing total cash outflows, which results in a large deficiency for that 3rd period. For period 4 in our example, receipts spikes up with eliminating the asset purchase and no longer the debt payment. For period 4, cash outflows comes down to something that's more normal, but we net with a large net cash positive. Step 2, calculate the surplus or shortfall by period. Starting with cash on hand at the beginning of the period and adjusted for the current period cash flows that are expected, calculate cash on hand at the end of the period. The result will identify shortfalls or opportunities which need to be addressed. Step 3, address shortfalls and the opportunities. Addressing shortfalls can take on a couple of different forms, and this approach we refer to them as remedies. Examples of remedies include additional borrowings, maybe sale of bulk wine, or potentially additional cash flow from, through contributions from owners. In periods of cash surplus, opportunities might include capital expenditures, early pay down of debt, or equity disbursements. So in our example here, we can see in year 3, our ending balance, we identified a deficiency. So for that particular period, the remedies are additional borrowings and, as an example, just a bulk wine sale, which ultimately adjusts our cash balance back to a positive. What's more telling here, and you could make the argument that equity disbursements could go up above, but I've included them down here as, in looking at this analysis, if you knew period 4 was going to have a cash surplus, and let's say you had a monthly disbursement for equity disbursement to owners of $10,000 a month, and you knew you were going to be short in period 3, but you knew you were going to have a surplus in period 4, you could defer that equity disbursement potentially to period 4 when you have some additional cash flow. Something to think about. Step 4s and 5s really look at opportunities for a cash surplus, such as funding some sort of contingency pool, and 5 being funding some sort of capital project budget, but a little bit more on that later. Again, this is just a brief example of balance sheet review of cash that entails determining expected cash receipts and outflows, calculating the surplus or shortfall, and planning for remedies to manage cash flows. Moving on to inventory, there are numerous potential items to consider when reviewing inventory. This list is not meant to be all-inclusive, but are just some examples to consider. So balancing competing desires. The sales department may desire unlimited inventory in both varietals and quantities. Production may wish to have an unlimited supply of raw materials. And procurement, they may want to maximize discounts through volume purchasing. Each of these conditions creates pressure to increase inventory, but it comes at a cost. Inventory levels must be maintained in a manner consistent with market-based consumer demands. To manage these competing demands, a policy addressing overall company objectives, which are communicated to each department, might include the following elements: number of varietals and quantities to be produced, consideration of carrying costs, material costs, and a difficult one to quantify, stockout costs. Now, the policy should marry up with cash flow considerations from the cash review on the previous slides. One additional thing I want to highlight in here is communicated to each department. I've run into a couple of situations on the consulting side of things where certain departments, whether it's the sales, production, or procurement, aren't necessarily all in sync. And when that happens, they kind of take on a siloed view and try and maximize what's just in their world. Well, because it's kind of limited, it doesn't have the objectives of the entire company, some problems came about over time. So make sure that policy is really communicated and that your leadership team understands where the direction is headed. Another good starting point for inventory review is to compare actual sales with a predetermined forecast. The net over-under will provide a data point and perspective on next steps needed to manage inventory levels. Inaccurate sales estimates may pose the most significant risk of errors in inventory management, meaning an overzealous sales forecast can result in unneeded buildup of inventory. Once you get comfortable that sales and inventory levels are in sync, a review of inventory ratios could come next. After calculation and comparison to prior periods or expected results, understanding unusual variances, if any, will illuminate areas for focus or opportunities for improvement. Examples of the common ratios we kind of talked about on a previous slide. Now, the review of bulk wine and possibly bottled wine will require costing on at least the same periodic basis. If costing is only performed annually, the effectiveness of periodic review will be reduced. The frequency of costing is a matter of judgment. However, 2 to 4 times a year will provide more data points than simply performing it annually. More data points during the year provide greater lead time of potential warning signs, allowing for flexibility in potential action steps. It's worth noting that the costing methodology that you use should be consistently applied so comparability of inventory ratios is effective. Like I said, there's just numerous things with inventory. It's kind of the big one, but at the heart of the inventory balance sheet review is answering such questions like, do I have too much wine? Do I have too little wine? Is it too costly to produce? Or possibly even, am I incurring unnecessary losses? I encourage you to review your inventory policy, review actual inventory levels with forecast, and review key ratios. Continuing down the balance sheet, and after taking care of kind of the big ones of cash and inventory, we can move a little bit more quickly as far as the time needed to dedicate to these. With accounts receivable, we'll cut them into 2. In one bucket are trade receivables. Here, timeliness of billing and monitoring of past due receivables are 2 items to focus on. Wineries usually don't have problems in either of these areas, so this analysis should be easy. At period end, and with the expectation that past due receivables will be minimal, review of an AR aging should be quick. In the second bucket, other receivables, such as related party, employee, etc. Some items to consider include, is repayment occurring as scheduled, or is it just the cash is being tied up for another purpose? Again, sometimes I see some a little bit creative receivables out there, and ultimately they are tying up cash for the business. As a side note, according to the certified fraud examiners, the billing cycle is still one of the most targeted cycles for fraud, and so this is just something to consider and be aware of. For prepaid expenses, really not much emphasis here. Incentives for converting cash into another short-term asset are usually low, so a quick review of the account balance at the end of the period is probably sufficient. For fixed assets, given the long-term nature of fixed assets, periodic review may occur at larger intervals, maybe such as annually. Development of a multi-year capital acquisition budget and incorporating it into the cash management approach will provide insight and highlight into future financing needs. Because age and use deteriorates their usefulness, monitoring changes in repair and maintenance costs is also indicative of a need to budget for significant repair or replacement, or possibly suggest an improvement that should have been capitalized. Another item to consider is periodic inventorying of fixed assets. By keeping the fixed asset listing free from assets no longer in service, the process of inventorying annually is manageable. In my experience, annual counts are near the bottom of a company's to-do list, as most assets no longer in service have net book value of 0. As a result, the number of years that pass between counts increases. And as that number increases, so does the effort the next time a count is performed. For debts, some things to consider. Each of these should be reflected in the cash management approach, plus be consistent with the inventory policy. Thoughtful cash management planning ahead of time may lead to more efficient use of cash, thus utilizing borrowings only when needed. It's often easier to obtain favorable financing terms when the need is not urgent. An immediate benefit of maximizing cash utilization is reduced interest costs. For long-term financing needs, this will become apparent via the fixed asset acquisition budget. Aside from the actual cash flows, it's important to consider and ensure that the company's capital structure can be supported by its operations. If overburdened with debts, the company's sales and collection activities may not provide sufficient cash flows to service its capital structure. In recent years, this margin for error has narrowed. Sensitivity to changes in market conditions on a company's capital structure and ability to service that structure needs to be understood. As an example, obviously everybody knows what happened in 2008 with the economy and everything that transpired subsequent to then. One of the things that I see is the companies that had management plans in place to catch changes in their business environment were able to act more quickly. Those that didn't act, and maybe didn't even act at all, and suffered because of that. So a tool that can assist in reducing the risk of error is forecasting. For forecasting, consider current and future market conditions and use historical data sparingly. We've talked about a little bit this morning that the past can highlight a little bit, but the recent past has been nothing but normal. Unfortunately, we've been experiencing back-to-back sort of odd years, and I'm not sure we've reached a new normal, but I think we can all agree it's not the old normal. Regarding the model, more on this in a moment. Again, keep the monitoring simple. Spending the time to have a solid market-based forecast is great, but if monitoring of actual results with expectations doesn't occur, you haven't maximized its potential. So how might this look? A full model forecast would include a balance sheet, income statement, and statement of cash flows. Due to limited space on the PowerPoint slides, I've only included an example of the balance sheet. For the model to be useful, it should be tailored to match other company reporting requirements at an aggregate level. So if there's external reporting, this forecast should marry up with that. This will simplify the comparative analysis. Additionally, by increasing the automation of values through the model, regular updates will require less time and effort. For example, it may be easiest to start with income statement inputs, expectations of quantities to be sold at expected prices, less production and fixed costs, would feed monthly detail schedules that ultimately roll up into the aggregate level seen here. In a best case scenario, this means each number on this particular slide would be a formula pulling from a detailed analysis. As the inputs change, the aggregate level report updates automatically. The more automated the forecasting model, the easier it is to perform what-if or sensitivity analysis based on changes in inputs. As formulas update automatically, the model becomes an efficient tool. Taking it one step further, I've added formulas calculating key ratios at the bottom. By doing so, I've incorporated multiple functions into one tool, adding additional efficiencies. So multiple functions, we talked about tracking historical ratios. Here, we've incorporated that into our forecasting tool. Results of forecasted ratios that we've calculated here can be compared to historical data for reasonableness. If one of the calculated ratios is outside a historical range, it may suggest inputs are not representative of normal operations and thus may require extra effort to achieve. So let's walk through some of the thoughts going behind this. And again, this would be one slide. So let's take a basic full model forecast. We'll think of 3 tabs in Excel. This one would be the aggregate tab, we have a detailed tab, and we have the input tab. Now on the input tab, it might be starting out with, here are the particular varietals that we're selling, here are the price points of those varietals, and here are the total amount we expect to forecast to sell for the year, and maybe break that up based on seasonalities that you experience throughout the year. We would then take an expectation of what the historical costs of those varieties and quantities would be, and input that into either a cost per case, some sort of metric, and then maybe use an inflationary rate as we go out for years 2, 3, 4, and 5. On more of the overhead type expenses, again, we might look at accumulating those on a per month dollar amount in order to drive formulas that would be on our detailed tab, where we would accumulate data on a monthly basis. So we would have, maybe the income statement, the cash flows, and the balance sheet all in on a monthly basis. That schedule is going to be quite large. Now, for purposes of making it digestible and going back to keep it simple, that data from a monthly, as you go through and calculate it and make sure that everything kind of seems like it's working correctly, would flow up into an annual, what we look on this slide here. So again, you would have each of these numbers here that would flow from another detailed schedule, meaning as inputs change on the input tab, they automatically flow through the detailed analysis, of which you can take a scan through and look and make sure everything is working correctly, and then obviously that gets aggregated into this schedule here. So for cash, this could easily come from the cash management approach. For accounts receivable, this is a function of probably, timing being that it's probably at the same, let's say year end, let's say 12/31. If you have an expectation of certain incremental sales growth, possibly could apply that to the receivables. Inventory, again, going back to your policy. For prepaid expenses, not much going on there, so probably something fairly consistent. $10,000 here or there, or incrementally increasing that for some sort of inflationary rate probably isn't going to make a big difference, so probably not something to worry about. For fixed assets, unless there is a planned large capital project like a new building of some kind or a new acquisition, these fixed assets probably are going to stay fairly constant with additions and depreciation maybe netting out. Other assets, could be a hodgepodge of anything. And again, most of what I normally see is those amounts are not really influencing things too much. So whatever that number is, maybe, again, probably don't need to pay much attention to how that's going to change throughout time. Line of credit, again, this is probably a relationship with the cash management tool. Same thing with accounts payable. Accrued liabilities, think about the drivers that are driving those accrued liabilities. So if you have an expectation of a new building and there's going to be new employees, obviously your accrued liability, maybe your payroll liability at the end of the period might go up, so to reflect that in there. Whatever those drivers are, that'll help as you project out to a 5-year period. Current portion of long-term debt, and it's long-term debt. This one's pretty easy, and again, unless there's some big project, these amounts are spelled out in the amortization table, so those ones are really easy to get access to. Mostly for forecasting purposes, equity is pretty much a plug. And then obviously you can calculate your ratios. I've only included 3, but you could include quite a bit more. Now, depending on your skills with Excel, creating such a model may be overwhelming or too time-consuming. If you don't already have a model, I encourage you to reach out to a trusted advisor for assistance. For purposes of balance sheet management, this really is a must-have tool, and the upfront cost will likely pay dividends and restful night's sleep. This concludes today's program.